Hey, good evening, everyone. This is Trader Tim coming from EminiMind.com, and it's actually Sunday, September 18th, doing a market analysis video for you in the evening here. Big week this week, and last week we completed our expiration for September, so now it should be on the December contract for all of your futures contracts. And this week, Wednesday, we have the Fed meeting announcement, which should be a big one. We kind of know, or the expectation that the Fed's going to raise rates about 0.75%, shouldn't be a surprise. But to have that information hit the market will be very important. It's usually around this time of the year in September, around this Fed meeting, that we kind of establish our fall trend. So from now through the Christmas holiday, we should have a lot more opportunities, a lot more volatility. Even though the summer was pretty decent, the spring and fall typically have much more trading opportunities, so it's a good time to be active and day trading. I wanted to talk about last week, but before I do that, let's look at. So it's after hours right now. Markets are closed, but the futures are open, and I've got the 24 hours worth of data on here, and I want to show you um, if so. We've got this little hammer formation. If we just look at trading hours only, it looks like this. Kind of a bullish close yesterday or Friday. We did close below the 61.8, so that's pretty bearish of that long, and the 50% target on the short is down at 37.80. Now, usually the Tuesday and then Wednesday morning of the Fed meeting, the markets end up being pretty flat, especially Tuesday. Is usually the case, and then Wednesday it's usually slow until the afternoon when they come out and Powell gives the announcement. Monday could be kind of a crapshoot. We've had puts on since the this day back here on the 12th. Was not expecting them to do so well so quickly. I put them on with the expectation that we might have a big move come this week. And so, that being said, I did close some out on Friday just because we had such a big move this week. And with a bullish close like we had on Friday, I was a little bit concerned with the gap up. Um, the benefits of buying puts like this ahead of a news announcement is if you do get a slide, they really accelerate in your favor very, very quickly. And so even though I closed some of them out on Friday, uh, if we keep going down, then so be it, and we'll keep riding it lower. But I wanted to lock in some profit as well, since there was a pretty big move already, and we haven't even got to the Fed meeting announcement. But going back to this kind of this hammer pattern, one thing to watch for tomorrow, if we gap up, a lot of the times when you gap up at lows, that's a move that you want to buy because it's potentially the start of a new uptrend. When you gap down at highs, that's a move that you want to sell because it's the start of a new downtrend. But what to watch for, what I'm watching for Monday, if we gap up or if we move above Friday's high and we can't stay above it, like if we move above it in the morning and then we come down and break the candle's low from Friday, that would be super bearish. I'm going to actually turn off the extended hours now so we can look at the actual price level. So if we move above 30, let's see, 38.96 tomorrow, but then we subsequently fall down throughout the day and break the candle's low, 38.53, that would be super bearish. You'd end up with like a bearish engulfing pattern where you have started the move up and then failed that setup. And it should be very easy for us to make it down to this 37.82 area if that's the case. If we gap up and then close without filling the gap, then we're probably going to have to wait till either Wednesday afternoon or Thursday to see some sort of bigger volatility or bigger move. You could draw a retracement like this, but I usually don't draw. I leave the original retracement up, so like this short, I'll get rid of the long since we broke it already. But this short, I will leave this drawing up until we either break the 61.8 or complete the negative 23% target. So, drawing the next retracement, yeah, you could do it, but a lot of the times you just end up kind of chopping around a little bit versus um, having like if we move up, I guess the one case you could make if by drawing this next retracement is its negative 23 also lines up with the larger 50% negative 23. So if you want to draw it up, great. Otherwise, that bigger retracement, make sure to leave that on your chart so you don't lose sight of where that 61.8 is. And I want to go to last week, Wednesday. Let's see, 14th. Yep. So last Wednesday, I really didn't have many trades last week, being the expiration week, and then coming to the Fed meeting here. Didn't do a whole lot last week. Did have a couple nice 15-minute breakouts earlier in the week that went for 20 points, so that was nice. But didn't have a lot of retracements. Let me flip this to the same chart. And so when you get into this kind of a situation where you have a 50% long and you come down to the 61.8 and you kind of broke it a little bit by a couple of ticks and you're just kind of hovering along or kind of coming down to the 61.8, but then at the same time you're trading up at then you bounce and you come up to the 50% short and even break that 61.8. You probably heard me say this a lot if you watched any of these videos, but you want to stay out of the middle of this range. And you could literally draw a box around it like this, or just kind of, mark the high and low and just say, okay, I'm not going to trade in the middle of this range. It's very easy to get chopped up and to, you zoom in so far like this, and then you come in here and you're taking, retracement entry, and then you get stopped out, and you say, okay, well, I'm gonna take it in the other direction, and then oh man, get stopped out, and then okay, well, I'm gonna try the other direction, and you're in this cycle of just nothing seems to be working. But if you zoom out, and that's why I like having the larger time frame next to my smaller, 512 tick chart. If you zoom out, it's much easier to identify this consolidation and then just stay out of it. And then what you want to do there is look for, if we move above the 61.8 or below the 61.8, then you can look for either a continuation to the downside like we had, or you could watch for a move down at lows, see if there's any kind of bounce, which we didn't have. But those are kind of the two places that I'd be looking for trades. A continuation when we actually break the 61.8 by, of considerable margin. Once you establish this range, like up here, you broke a little bit, but then fell back into the range. Just use that as the high and say, okay, we need to break that swing high before getting into a trade. And that way it keeps me out of a lot of this chop. I don't end up with, days where I have back-to-back-to-back stop outs and just, come away with nothing. So there's much more often I come away with, a day where I just don't have any trades. And that's totally fine, because then you catch a couple of big winners, and all of a sudden it's a great week and you've made 3 trades, and it really doesn't matter that you only made 3 trades because you had a nice profitable week. So that being said, be careful at the start of this week. I likely won't be trading much at all Monday, Tuesday. So I don't trade Wednesday, the Fed meeting announcement, and then Thursday, we got Thursday all the way into December. Should be lots and lots of opportunities for some big trades. So we'll be doing our live trading session this week actually on Thursday. So if you want to check that out, EminiMind.com/VIP, and you can tune in there, answer any questions, and we'll walk through the morning and see what we get. So I hope everyone has a great week. Stay safe, and we'll talk to you all soon.